Hi, Ben Smith here with Cove Financial Planning. Want to talk through 5 ways to save on your tax bill before year end. We're dangerously close to the holiday season, New Year, so you have a month left or so to take a few actions to reduce your taxes for the year. Number one, double check your retirement plan contribution. So look at your 401k savings, look at your health savings account, for example, IRAs, if you have deductible contributions. Make sure if your cash flow allows, you're maxing those out to lower your taxable income for this year. You have until December 31 to save into your 401k and health savings account specifically. Number two, rough year in the market, consider harvesting losses in your portfolio. So this will include your brokerage accounts, trusts, for example. If you have securities or funds that have dropped in value, you can sell those funds, replace the fund with a similar one for 30 days, and then go back and repurchase it. And you can harvest that loss to offset against your ordinary income or your eventual capital gains. So number two, harvest those losses before year end. Third thing is double check your withholdings on your paycheck. If you're a salaried employee, you have until December 31 to make tax payments. If you've gotten a big bonus or a raise during the year, you want to make sure you're not underpaying your taxes. The penalty is going up just a little bit for underpaying, with inflation, like most things. If you're self-employed, if you have some freelance income, you have until January 17th to make your final quarter tax payment. So double check. The IRS has a calculator, kind of a boring tax calculator to figure out your withholding estimates for the year. Number four, rather, Roth conversions. So this is where you take money from a pre-tax or a tax-deferred account, like a traditional 401k, IRA, for example, and transfer for some of the funds into a Roth IRA. It's called a Roth conversion. Now you've got to pay taxes during the year that you convert. So if you convert $10,000 this year, for example, your taxable income goes up by $10,000. That said, though, that $10,000 now in your Roth IRA can grow completely tax-free. It can be withdrawn tax-free when you need it, probably during retirement years. And that account is not subject to required minimum distributions, or RMDs for short, which must be taken from traditional or pre-tax accounts at age 72. Finally, the fifth one is consider bundling itemized deductions. A lot of us are taking the standard deduction. It's almost $26,000 for this year. So most of us are taking the standard deduction. However, if you're adding up all your itemized deductions when you file, and you're finding that you're getting close to the standard deduction amount, you might consider it bundling itemized deductions every other year or every 3 years, for example, so that you can itemize in those specific years and get a bigger tax deduction. Easiest way to do this, if you're donating to charities, for example, you can stack those charitable contributions in one specific year, then take a break, maybe a 1 or 2 year break from donating to charities, and then contribute once again to charities or a donor advised fund. But bundling itemized deductions can help save lots of money on your tax bill if you're used to taking the standard deduction, but you're getting close to that threshold. In summary, check those retirement plan contributions, harvest those losses during a rough market year, double check your tax withholdings, make sure you're not underpaying for this calendar year. Roth convert if it makes sense and you're able to take that tax hit this year, might pay off down the road. And then finally, consider bundling those itemized deductions. If you have questions on any of this, feel free to reach out to me at ben@coveplanning.com.